Welcome to The Explainer. Today, we're cutting right through the endless marketing hype and skipping over those fiery ideological debates you see online. We're getting down to the absolute, brutal, cold math of protecting your capital. So forget the talking heads and forget the financial pundits pushing their own agendas. We are taking the two hardest assets available in the modern financial landscape and putting them directly head-to-head. That's right, physical gold versus a spot Bitcoin ETF. We're going to look at exactly what happens to your money over a one-year horizon when reality, fees, and friction actually hit the board. Let's set the stakes right out of the gate. Picture this, you've got exactly $50,000. And listen, this isn't play money you're looking to gamble with. You're not out here hunting for the next crazy 10x speculative trend or throwing darts at risky tech stocks. No, you've reached a point where capital preservation is your absolute #1 objective. You just want to protect this money from that silent compounding tax we call inflation. That's the whole shebang. No gambling, no speculation, just preserving your purchasing power over time. Section 1. The hidden costs of gold and the illusion of the spot price. Okay, let's dive into this. You might think you can just go buy physical gold at that exact spot price you see flashing across Bloomberg, right? Well, that screen price is a complete illusion. Let's aggressively break down exactly why. Say you contact a major bullion dealer today, someone like APMEX or Kitco, to buy 50 grand worth of physical gold bullion. Instantly, boom, you are hit with a dealer premium. Retail gold bars and American Eagle coins absolutely do not sell at the spot price. Those dealers have to charge a manufacturing and logistics premium. So let's use a conservative 4% dealer premium for this example. The moment you wire your money, you're paying $2,000 upfront just to acquire the metal. Before a single ounce even ships to you, your actual gold value has instantly dropped to $48,000. Now you've got to deal with logistics. Because let's be real, you cannot just leave $48,000 worth of physical gold sitting under your mattress. Well, not unless you want to trade your financial security for daily crippling anxiety. You have to store it properly. Sure, you could buy a high-grade physical safe for your house, but that comes with a massive upfront cost for delivery and installation. Or you go the route of a professional insured depository like Brinks or the Delaware Depository. The industry standard fee for that level of secure storage is roughly 0.5% annually. So to match the safety of institutional custody, you pay that fee. That's going to cost you another $240 for the very first year. All right, brace yourself because here comes the real shocker. Fast forward 1 year. Let's assume the gold market stayed exactly flat. It didn't go up, it didn't go down. But you need your cash back. You go to sell the gold back to the dealer. Well, dealers don't buy at spot either. They buy at what's called the bid price, which is typically a 2 to 3% discount below the spot price. Let's calculate a conservative 2.5% liquidation spread. On your remaining $48,000 worth of gold, you lose an additional $1,200 the very second you head for the exit. Section 2, the Bitcoin ETF math and the frictionless digital wrapper. Imagine it's a random Tuesday morning, 10 a.m. You take that exact same $50,000, but instead of calling up a bullion dealer, you simply log into your brokerage account and buy a spot Bitcoin ETF. Because these are massive, highly liquid, multi-billion-dollar Wall Street instruments, you completely avoid those heavy retail premiums. You're buying at the exact market price. The transaction cost, the bid-ask spread between buyers and sellers on the actual stock exchange, is absolutely microscopic. We're talking typically less than 0.02%. So on your $50,000 allocation, your entry spread cost is roughly $10. That leaves an incredible $49,990 actually working for you in the market. Now, let's focus heavily on the holding costs here, because this is a real game changer. With the ETF, you don't need to rent a vault. You don't need to pay for armored transport. The digital asset is secured by high-grade institutional cryptographic custody. So instead of an out-of-pocket storage fee, you pay an expense ratio. The current competitive rate for major spot Bitcoin ETFs sits at an average of 0.25% annually. Some, like Franklin Templeton's EZBC, are even lower at 0.19%. But let's just use BlackRock's standard 0.25%. On your 50 grand, this silently deducts just $125 for the entire year. It's taken fractionally from the net asset value every single day. You literally never even receive a bill. 1 year later, again, the market is completely flat and you decide to sell your ETF shares back into cash. You simply log in and hit sell. The exit spread is another microscopic 0.02%, which equals exactly $10. But here is the true magic of this digital wrapper. Your cash hits your settlement account instantly. It is immediately ready to be wired straight back to your regular bank account. No shipping, no physical appraisals, no waiting around. Section 3, the final friction invoice. a brutal side-by-side reality check. So the crucial point is, we really need to look at a direct mathematical autopsy of your $50,000 investment over a single 365-day period. Read these stark side-by-side numbers exactly like a final invoice. You started both investments with exactly 50 grand. In a completely flat market, the physical gold incurred a purchase premium of $2,000, a storage fee of $240, and a liquidation spread of $1,200. That is a massive $3,440 frictional drag. It leaves you with just $46,560. Now, look at the spot Bitcoin ETF. It had an entry spread of $10, an expense ratio fee of $125, and an exit spread of $10. That is a razor-thin $145 drag, leaving you with $49,855. The numbers really just hammer home the reality of your break-even point here. Because of all that physical friction, your gold actually has to appreciate by roughly 6.88% just for you to break even and get your original $50,000 back. It has to surge nearly 7% before you make a single dime of real profit. Meanwhile, the digital ETF wrapper requires a microscopic 0.29% market movement to recover all of your operational costs. Which brings us to Section 4, Sovereignty versus Efficiency, the ultimate financial trade-off. Look, Wall Street's digital wrapper has clearly and mathematically stripped away the operational inefficiencies of the material world. But as we weigh these two assets directly against each other, we have to pivot from the math to the philosophy. Because there is an unbreakable rule of wealth. There is absolutely no such thing as a free lunch in finance. You are always, without exception, trading one risk for another. With the spot Bitcoin ETF, you're buying ultimate cost efficiency, effortless scaling, and instant liquidity. Mechanically, it's far superior for moving capital, but what you are giving up in exchange is your sovereignty. Physical gold, on the other hand, guarantees absolute independence and tangible, physical control over your wealth. Because the true cost of all that ETF efficiency, it's reliance. When you buy an ETF, you do not actually own the underlying cryptographic keys to that Bitcoin. You own a regulated share of a fund. You are fully surrendering your sovereignty and trusting a massive chain of corporate custodians. Think about it. You have to trust BlackRock as the manager, Coinbase or Fidelity as the custodian, the SEC as the regulator, and your specific brokerage as the gateway. You are entirely integrated into the legacy banking system. So if there's a major geopolitical crisis or some kind of systemic financial freeze, your digital access literally requires permission. And you know, this brilliantly illustrates the real value of friction. We can completely reframe that massive upfront cost of physical gold. Sure, you paid a painful $3,440 in friction, but what you actually bought with that premium was an ironclad insurance policy for absolute independence. Physical gold requires no internet connection. It requires zero electricity. It completely ignores Wall Street trading hours, and it is entirely immune to any server compromises or digital hacks. It's an asset that exists entirely outside of the digital and banking architecture. It really is the ultimate insurance policy against the total collapse of counterparty trust. So you look at the cold math, and you start to realize this choice was never actually about which asset is strictly better. It's about deciding which risk profile perfectly aligns with your own mindset. Are you willing to pay the massive price of friction, losing thousands of dollars upfront for the absolute peace of mind that comes with total untouchable sovereignty? Or will you trust Wall Street's institutional architecture to ensure your capital operates with maximum frictionless efficiency? The market doesn't care about your philosophy. It simply opens every morning, runs the numbers, compounds the fees, and tests your conviction. So review those numbers, weigh the cost of sovereignty against the price of efficiency, and ask yourself, which risk actually matches your psychology?